We've had a few discussions here in the past couple of weeks. Let's see here. Did it go back to YouTube for me? Yeah, there we go. A few discussions the last couple of weeks. Okay, sorry. So we had this one here, stops on debit spreads and portfolio allocation. We had that talk here about using the same stops, the 1% rule and the 50% stop rule I'd mentioned for credit spreads, whether they were 7 days out, whether they were 40 days out. Oh, here's the one I was thinking of, closing credit spreads for the 1% rule and 50%. So we've had a couple discussions on those. Robert's question now relates to, would you use the same triggers trade management for a covered call as a credit spread? No, absolutely not. Okay, they're very different structures. They're both neutral to bullish, but they're very different structures and very different positions. And you can also do them very differently. What do I mean by that? With a bull put credit spread, Robert, I'm always out of the money. A bull put credit spread, I'm always below the stock price. If I'm doing a covered call, I may sell a call that's in the money, okay, below the stock, hoping to get assigned, having a better probability of getting assigned, just making the 2-3% return on the position, not continuing the trade, not planning on continuing the trade. Just get assigned, take the return, and move on and find a new position the next week or the next 2 week cycle, whatever my preference is. Or I could have bought the stock and sold an at the money covered call, just looking to maximize time premium and planning on managing it for maybe 3 or 4 cycles. Or I could have sold the covered call above the stock price using an out of the money covered call because I don't want it to be assigned and I just want to collect a dividend-like income on a regular basis. So if those are my approaches for a covered call, either one of them, what I'm looking for is going to be completely different. And what I'm trying to hedge and protect is going to be completely different than what I would do for a credit spread. All right. So, we just have the standard covered call position. Now, first off, the 50% concept is thrown completely out of the window, Robert. All right. Don't even consider that with a covered call. Why? Because in a covered call, remember, you're risking essentially 100% of what you invest in the position. Now, I buy TZA today I buy TNA today at around that price of $82, $83. I forget where it was. And I sell a call and I get $250 in premium. So I've got $80.50 per share invested in the position. A 50% loss would be if the stock fell down to $40 per share. I'm not letting that happen. This is per share. This is thousands of dollars. Okay, not hundreds of dollars that I have, or maybe just above $1,000 that I'd have in a credit spread position. I can't afford to take thousands of dollars of loss and lose 50% on a covered call. That's not the trick. Okay, that's not what we want to do. Yes, in a covered call, you would most likely use a stop somewhere at around 7% or so because, following the standard stock rules, following the standard investor business daily rules. If you buy a stock, you usually put a 7 to 8% stop on it. And hopefully it triggers during the day so you get closed out of it. And, if you're making 1.5 to 2% here, taking a 7 or 8% loss here, you've only wiped out 4 previous trades. Now, of course, we know what stops are. They're assumed insurance. So if it gaps overnight and drops down 15%, well, you're taking a 13% loss and you've just wiped out 6 or 7 previous trades. You would never let that go to 50. Okay, you would close it before that happens. So let's just take a search. We're going to take 3 searches. I'm going to use the basic ones, not the picks of the day. We're first going to look at an in-the-money covered call, and these stocks are going to be different. I've got Grocery Outlet, Devon Energy, and Wendy's. Okay, let's take Wendy's. This is an in-the-money covered call for 30 days out in time. Buy the stock at around $23, sell the January 19 strike, standard expiration, for a midpoint of around 430. We're 3 points in the money. We're 4 points in the money. So I'm really only making about 30 cents. But my debit's going to be $18.68. $22.98 for the stock, $4.30 at midpoint, debit of $18.68. And if I get assigned the stock stays above 19, we're going to make 1.7% 30 days. Not the biggest return I could expect to see, but pretty reasonable and pretty decent. Let's take a look at that profit and loss chart. This is an in-the-money covered call. I want it to be assigned on the position. I've got 30 days to go. Now, Robert, is the 1% rule a good idea to use here? Potentially. Meaning if I want to stay in the money to get assigned, and we've sold the 19 strike, and the stock falls down from where it is now at about 23, somewhere in the next 30 days, down to, let's call it 1920 or 1925, that'd be the 1% rule. I may consider buying this 19 call back and rolling down to maybe the 18 or the 17 to give myself a little bit more room, hope it gets assigned. Still, maybe in January, maybe I have to roll out to February as a better hedge in that case. That might be a good idea. But remember, you took in a fair amount of premium here. So your break even is actually 1868. Even though it won't be at break even if this happens, if it gets to 1868 before January expiration, you're still going to have to pay to buy to close the call. It's not going to zero until expiration. So this is the break even at expiration. Some investors might consider, yeah, I've got the hedge in place. So if it falls, it goes a little bit out of the money, falls a little bit below the short call strike price, maybe in that case, I'll roll it down again, maybe to the 17, maybe to the 18, maybe go out a month, depending on where the position is. So 1% rule might be okay as an exit. 50% loss? No, you're not going to take a $900 loss. You're not going to allow it to go up to $930 loss in this position. Where would that occur? Yeah, well, if the stock fell to like, what, 10? It falls down to $10, it falls down, that'd be 868, falls down to 7. You're going to close before that happens. All right, it's at 23 right now. You're not going to let it drop to 10. You're taking a 50% loss. What you're probably going to do in this case, in the money covered call, want to be assigned. I want the higher probability of being assigned. In this case, the stock can fall 4 points before I'm technically losing money on the position. That's good. So what we're looking at now is that, yes, if it does start to fall and it gets within near my short put call strike price, I may close out the position, may just exit it. Again, as I mentioned, what we'd most likely do here is the stock's at 23. I might set a stop where if the stock drops 7% from my purchase price somewhere in the next 30 days, then I might just liquidate the position and get out, whether it's for a small loss, maybe even a small gain, depending on how close I am to expiration. Again, why am I mentioning the 7% rule? Because if this is a 30-day trade and the stock falls 7% in the first 30 days, what is that telling me? This is still a neutral to bullish position, Robert, just like a bull call debit spread, just like a bull put credit spread. If it falls 7% after I get in the position within the first 30 days, that's telling me this stock is doing the exact opposite of what I want it to do. So I'm probably going to look to get out of the position. Okay. But again, what is 7% of $23? We're around $1.70, $1.75, I think. I have breadth to break even at 1868. So maybe with this in the money covered call, I am more focused on the break even and the strike price. While we're here, let's just keep with Wendy's. That would be the easiest thing. I don't have to go to another search. What if I'm trying to maximize time value, Robert? The at the money bell curve, the highest time value at any time on any option series, the option that's trading right at the money. So we look 30 days out to January, and I sell the January 23 call at 55 cents. Not the highest premium. It's the highest time value. See, the 22 call is priced at $1.20, $1.30. But basically $1 of that is intrinsic value. So I'm only getting what? 20 or 30 cents of time value, of true profit. I'm giving up $1 going in the money. This 55, 60 cents here at midpoint, that's the highest time value. So let's go ahead and sell that 23 call there. Okay, that's a 2.8% return. I collected 62 cents. I know by break even is about 22.30, 22.38, 22.35, depending on the premium I get. Okay, and we're at 22.98. This is where that 7% rule comes into play. I'm sorry. There we go. I'm sorry, folks. This is where That's 60 cents there, 2.8% return. But this is really where that sort of general rule of 7% stop comes into play. 7% stop was around 165, 170, I think. Okay. So if the stock falls 165, it's going to be below 22.38. I know that. But it's fallen down here to about 21.35. And I would consider maybe rolling down one more time or just exiting. Why? Because I took in the 62 cents, cost basis of 22.38, stocks at 21.35, roughly my 7% stop. I'm only losing $1 on this position, which is, okay, 3.5, 3.6%. I'm trying to keep it in that range, right? I'm trying to keep it in a range where any loss I take on the covered call isn't really going 2 or 3 times more than the average return I'm making on my winners that do go the right way. I've got to be careful because, as you mentioned, what can't I do? I can't let this go to a 10% loss, 15%, 20%, 30%, and just keep going saying, oh, as long as I keep rolling down and selling calls, I'll be fine. No, if I'm making 1 or 2% a time premium, but losing 10, 15, 20, 30%, I'm losing much more on the stock than I can ever make back on those little call premiums. And unless the stock recovers, I'm never going to be able to get back to break even. It might take 12 months, 10 months just to get back to break even. You could probably put your money somewhere else rather than trying to catch the falling stone by just rolling down the covered calls. Reverse. This isn't going to be a great example, but we're going to use it. The out of the money approach for covered calls trading. I want to hold Wendy's long term. Terrible. I want to hold Wendy's, long term. It's a core holding in my account for whatever reason. I have a large amount of shares. Maybe my cost basis is actually $11 per share. I don't want to sell to close this. I don't want to get this assigned out of my position. Okay, I don't want to get it called away. But what I do want to do is attempt to collect a dividend-like income, 10, 15, 20 cents or so, month by month, to keep lowering my cost basis and give me a little bit of extra hedge for uncertain market conditions. We know that a collar or a married put play specifically would be much better in that situation if I'm looking to hold these positions long term. However, well, I'm already within the 1% stop rule here with this approach for the out of the money covered call, aren't I? And I want the opposite. It's not that I don't want to be successful in the stock, but I want to get as most of this 20 cents, this small out of the money premium as possible to keep hedging the cost basis on my security. So in that case, what I might say, Robert, is that you'd still maybe keep the 1% rule, say stocks at 23, but you're going to use it as you would a bear call credit, not a bull put credit. Because I don't want this position to go in the money. So maybe I look to close it. If the stock is, I'm selling the 24 call, my apologies. So if the stock goes up to 23.75 somewhere in the next 30 days, I may look to buy to close this call at 24, roll it up to the 25, maybe to February, to try to stay in the credit, try to keep the return coming in. But again, that depends on what structure of covered call you're using and how you're using it. In a credit or debit spread, you're looking to have the position expire worthless as much as possible. We're setting those 1% rules on a bull put credit spread that's out of the money because I don't want to be assigned a deal with a stock. That's not why I'm doing it. Yeah, because this isn't a standard, let me do the 20. This isn't a standard put spread I would use, but we're here on Wendy's, so let's keep it on Wendy's for the eyeball example. So going out to January, 8.1% return. I'm selling the 22 put and buying the 20. Okay, so 1% rule here. Yeah, 22.25. I may look to close the position. Of course, we're probably not entering this position following our guidelines anyway. I'm not saying Wendy's is a bad stock. I'm just saying it's not a good stock, perhaps, for a good bull put credit spread. What we look for, that is. So, in the money covered call, here, I know my break even on the bull put is here, but with an in the money covered call, I may consider the 1% rule, Robert. But again, at the same time, I know that my break even is here. I'm not worried so much in an in the money covered call position of letting the stock go below the short call strike price because I already own the stock. I bought the stock. The reason I don't want to let the stock fall below my bull put credit spread is I don't want to buy the stock. I want the puts to expire worthless, or I want to manage them before they go in the money because I don't want to risk that assignment. That's not why I'm using that trade. But in the covered call, I already own the stock. There's no fear of that. The call would just expire worthless. If the call is right at break even on expiration, I might just let it expire worthless, or probably buy it back for 2 cents and roll to the next week. But that's why they're different. And you started out of the money here with a bull put credit spread, just like you started in the money, perhaps with that 22 strike covered call position. The goal being in that case would be to be assigned. Make the maximum return, in our example is about 1.7%, and then move on. And here with the bull put, I kind of want the same thing. I want it to expire worthless, so I'll maybe make a profit of 8.1% and don't have to worry about any management. 1% rule might apply to both. 1% rule won't really apply to your at the money covered call positions, your out of the money covered call positions, and that 7% rule we mentioned as well is probably good for both. The bull call, I'm sorry, not the bull put, because you can see it's already, this is a bad structure, as I mentioned, because we're not 7% out of the money right now at the 22 strike. Oh, yeah, no, we're not. We're not. Okay. So that's the case there. But I would use the 7% rule, as I mentioned, for the at the money, the out of the money covered call also. But again, if I'm using an out of the money covered call, I've probably already admitted that I want to hold the position longer term. Okay. So for other ideas on that, again, if you're following Ernie's sort of structures in the covered call, the weekly picks of the day, he explains right here what kind, I'm sorry, if you click on see how we develop these results for these positions, he'll walk through what his testing was and what stops he used. I believe it was maybe 7% here on the weekly picks of the day and a little bit deeper decline possible here for the monthly picks. They just click on see how we develop those results, and Robert, that'll walk you through it. You know, Pavol, I'm trying to think of if I've talked about this before and if I ever came to a conclusion. It's a fantastic question, this next one. And it's a very, I don't want to say common question, but it's a question that comes up. And it's related to parity trades. We know that an out-of-the-money bull put credit spread is a parity trade to a bull call debit spread with the same strikes. The difference between the two is the number of transactions that you have to make to close out of the position. On a similar note, what Pavel's asking now, related to parity trades, is there an advantage to selling deeper in the money covered calls as opposed to selling the parity OTM puts? All right, well, let's take a look at this covered call position. To enter our Wendy's covered call, I'd buy the stock at $22.98, and we saw a midpoint that we may or may not get with this in the money 19 strike call at $4.30. Well, anyway, that lowers my cost basis down to $18.68. That's $1,868 out of pocket of this position. I own the stock, and as long as the stock stays above 19, we get assigned and earn 1.7%. $18.68, my cost basis for 100 shares, of course, naturally easily works out to be our break even on this position, how far the stock can drop before we start losing money on the trade. 2 transactions, not such a big deal now with the commission costs where they are. 10 years ago, I would have mentioned that as a possible deterrent. Hey, if you're comfortable with the naked put position, cash secured naked puts, and you want to save a commission, you would do it. Now, brokers usually give you a break if you do the buy right. You do it all together at once. They may charge you a little bit less for one side or the other. In the old days, hey, it'd be $15.95 for the stock and $7.95 for the call. If I just sold a naked put, it'd be $7.95 plus what, $1 transaction fee, $1.20 transaction fee. Much cheaper commission-wise just to sell the naked put. But again, they would give discounts if I did it all at once as the quote-unquote buy right in that case. So I'd be able to take care of it there. But our 19 strike, January 19. Okay. Here's where things get dicey. This is only a 0.3% return as opposed to the 1.7% return that we saw. This just answers the question right there. I wouldn't even attempt to do this because I'm only getting 5 cents. It's got a 0 bid and a 10-cent ask on the 19 put parity trade, same strike. I wouldn't even bother with it. But now that begs the question, why am I seeing this? what you run into with too deep of in-the-money covered calls from time to time is that the bid-ask spread is so wide, there's no guarantee you're going to get 430. My option is $4 in the money, so I'm at least getting $4, roughly, right? It's at 23. We're selling the 19 call. The market maker has to be fair and give me $4. But he's not going to let me get filled at 430. He's pushing me to 405. The same price I could hopefully get here on this position. Let's look at a better one. This is perfect. The 21 is still in the money. We're 8.6% in the money, still offering a good time value. Well, it'd be good time value for a 2-week out trade, not really a 30-day trade, but we're at 0.7. It's $2 in the money, so it's about 5 cents. And the naked put here is about 10 to 12 cents. What I'm looking for here is the time value. 17 cents. I'm sorry, I read that wrong. 17 cents here and 15 cents here for the ask time value. So this one's giving me a little bit more bang for the buck if I can get filled closer to that price. No guarantee again. That's just the ask time value. I'd really look at the midpoint time value. And here it's about the same as well. But here it's showing me the covered call premium is a little bit better. And what I'm seeing in general here with the bid-ask spread is 23 cents, and that's 32 minus 7 is, yes, it's 26 cents, 25. They're about the same. It's really about 25 time value midpoint for the 22 call versus 23 midpoint for the 22 put. So an extra 2 cents or so. That's really what you want to look at. It's not just so much about which is giving you the best bang for the buck, but what is also the likelihood you'd get filled at these positions, Pavol. That's what we're also looking at in that case. So player's choice, really, is what it comes down to. They are parity trades. You have the same risk-reward profile. You've got the same probability. What you're looking for is which one do you feel you can get the best fill price from? Hey, the question from earlier from Robert about open interest and volume, maybe that would come into play here. If I see more volume and open interest on the calls and that makes me more comfortable, I might lean to the covered call position, in the money covered call. But if the bid-ask spread is really wide and I'm not even clear I'm going to get that because it's off parity in a sense, then maybe I'll go ahead and look at a different thing. Let's take a bigger stock that offers some weekly options. Take a look at Apple. Just go to next week. New Year's Eve expiration. And let's see, go slightly in the money here. Okay, I'm sorry. So Apple's at 175.64. 165's, these are all pretty wide too. These in the money ones, this is a good one. The 170, not too deep in the money, I know. 680 midpoint, reasonable. 670 bid, 690 ask. We're looking at a time value here. About 0.7% for a 1-week trade. That's really good for pretty good for this in the money position. 0.7% time value, almost identical on the put. I'd be getting about 115 here in premium or 0.7% return if it expires versus the 680, giving up about $5.60 of time premium. So it'd be at about 119. Again, they're fairly even. Okay, so which one is the best situation to be in? You could roll and adjust either way. You could roll down the puts, Pavol. You could roll down the covered calls if you get in trouble. You could close both out. Of course, just liquidate and take a small loss in that case as well. One advantage about already owning the stock, of course, is if it fell down and you wanted the call expired, you already have the stock to do a stock repair. But again, if we're talking about that, if the stock fell to 155, you didn't close the put, well, yeah, we'd be assigned at 170, have a cost basis around 168, 80 or so, and we could look to do a stock repair in that position as well because the stock would have already been put to us. Okay, I do know this isn't a fair assessment, but I do know that covered calls are probably the most popular option strategy. That's an incorrect term. You know what I mean by that. What I mean is covered calls are the most commonly used option strategy. The reason why is because any new investors that usually come in, especially to the older guard brokers, and they apply for options trading, they've never traded options before, they get level 1, which allows them to do covered calls. And then you've got customers who, Fernando, For example, he might consider himself a spread trader, or sorry, Fernando's question is next. That's why I just picked. I'm not picking on him, but I have customers that mostly trade, let's say, diagonal spreads, straddles, and then some credit spreads. That probably represents most of what they have in their portfolio. But somewhere in the background, they've got shares they've had for years of a IBM, Hewlett Packard, something along those lines, and occasionally they sell calls against it. So they're covered call traders, but their really focus is on other things: spread positions, diagonal spreads, long straddles, long strangles. Maybe they're doing something else along those lines. Both are good strategies to use. Both are popular strategies. Do not get me wrong. I'm just saying that covered calls, I know, is considered the most popular or most used because most new investors are using those when they get into options trades, as well as the old guard, as well as the intermediate. But a common approach is to gravitate towards naked puts and then maybe calendar spreads, the quote unquote poor man's covered call, delve into collars a little bit for protection, then move into bull put credit spreads after realizing the idea of the naked puts and the OTM naked puts. Hey, I can free up the margin by doing the bull put, still on quality stocks and still getting a leverage, or now getting a leverage return in that case. It's a great question that really doesn't have one great answer to it. If your stock pays a dividend, stay in the covered calls. But you're using in the money, so you're hoping to get assigned anyway, so you're not planning on using it as a dividend hold. So that almost is irrelevant as well. You see what the struggle is to answer this question with one clear answer, Pavol, because it all depends more on player's choice, the investor's preference. It's not really that one is better than the other, but you're on the exact right track. If you're just starting to open a new position, you're looking at a covered call, you like the return, take a look at the parity. Always take a look at the parity. I always look at the bull call debit spread before I enter a bull put credit. If I feel I can get more bang for the buck, I might enter the bull call debit spread position, even though I found the search on the bull put credit spread criteria. And it's just because if I feel I can get those midpoints and say maybe get a 17% return, where the bull put at midpoint or a little bit below midpoint would be giving me 13%, I might not get filled right away, but I might try it, get a little bit more bang for the buck if it's there. But most of the time I see the bull put is offering a better chance of getting the prices that I want, as the in the money calls, as we just saw, tend to have a wider bid-ask spread. It's not necessarily a guarantee I'm going to get the best fill price on that position. I want to see what they're offering on the puts too. So I say, oh, hey, Wendy's, I might get about a 30-cent premium if I get filled at midpoint going 4 points in the money. Then I look at the put and see they only have it at 5 or 10 cents. I know he's not letting me get 30 cents for that call. It's going to be even. Okay. Oh, okay. So Pavol, yeah, that's. I wish you would have, but that's okay. It was still a good discussion. I wish you had included that. Yes, if you're trying to play the ex-dividend play with the hope of getting assigned on an in-the-money covered call where the ex-dividend date is before your expiration periods, between when you enter the trade and your expiration, yeah, you stand a better chance of getting assigned, earning that return early. It's not a guarantee, though. It's not always a guarantee. It's something that happens frequently. But remember, being in the money, crossing ex-dividend date is not a 100% guarantee you'll get assigned early. Does happen a lot. Not a 100% guarantee. But yes, if that's what you're trying to play, then you would go with the in the money covered call. You wouldn't even consider the naked put, because the naked put's not going to expire early. All right? You can get assigned early, but you can't have the naked put expire early. The only way a naked put can expire early is if you get a chance to go in and buy it back at 1 cent. That's it. Okay, after a large move. Now we get to the proper one. Reminders, of course, that today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. I'm not saying you should do an in-the-money covered call, out-of-the-money naked put, bull put credit spread on Wendy's or on Apple or anything along those lines. We're just using those for the samples. Options do involve risk, as we've seen, and may not be suitable for all investors. Why did that do that? Sorry, folks. All right, great. So we showed some of the search capabilities today. We showed the profit and loss chart. Didn't even look at the portfolio today, but if you like some of the tools that you saw, remember you can take a free trial at any time. Just go to PowerOp.com, enter your name and email address. No credit card required. You'll have full use of the site for 14 days. After that, subscription started at only $45 per month. We do offer different level of services, enhancing up to the delayed level of service at only $65 per month, 12 to 15-minute delayed data, more access to the historical service on top of the 20-minute delayed. So 20-minute delayed service, 15 to 20-minute delayed service, plus full access to the historical is only $100 for both. Of course, the real-time and the all-inclusive premium service, the whole kit and caboodle, for lack of a better term. You can cancel at any time. Further education, I mentioned to Pavol to check out those bull put credit spread videos, the high IV bull put search results there. You can see other videos directly on our webinars page. Most of those are public. Just go to PowerOp.com and click on the free webinars. Or, of course, you can scroll through our YouTube channel or search on our YouTube channel by strategy. If you think of any other questions, give us a call. Send us an email. Send us an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Remember, trial members and subscribers can schedule a free coaching session at any time. Just when you're logged in under the main home tab, click the free coaching link and pick a time that fits for your schedule. All right. Kip says, great session, Mike. Thanks so much. Best wishes to you and your family. Thank you, Kip. I'm glad you enjoyed the session. Happy holidays to you and your family as well. Have a fantastic weekend. Fernando says, thanks, Mike, for your opinion. Fernando, you're welcome. It does come down to your risk-reward tolerance. I like the structure, but I'd want to step back and really ask myself in that case, looking at that butterfly, where does my real true target for the stock? Where do I want to, yours gives 2 ways to win. If it doesn't work out, I get it, and that's great. But again, I still want to look at it and say, now, do I need to overcomplicate this? But if this is my target range, what do I got to do? Is this the best trade? Sal, didn't have any questions today, Sal, but it's great to see you. Says, many thanks. I want to wish you and your family a very Merry Christmas. Thank you, Sal. Very Merry Christmas to your family as well. I'm sure I hopefully will see you before then, Sal, but Happy New Year's as well if I don't. And Pavol, you're welcome. Thank you for the great questions there. And Merry Christmas to you as well, Pavol. And Happy New Year as well. And of course to you, Fernando. And Merry Christmas to everyone. Happy holidays as well. And if I don't see you before next Friday, I'll be here. But if you can't make it to one of our next webinars, Happy New Year's as well. You'll be seeing more from me soon. Again, we did archive these presentations. I'll start cropping them up as I always do. We'll get some of them posted tomorrow. Maybe leave you guys alone for a couple days so you can enjoy the Christmas weekend, and then we'll post the rest of them on Sunday as well. So take care, everyone. Remember, close your positions, roll your positions, adjust your positions tomorrow, because tomorrow is expiration day, Thursday the 23rd. Market's not open on Friday. We'll see you soon. Take care. Good night.